Two people walk into two different dealerships on the same Saturday morning. Person 1 walks into a Toyota dealership, sits down with a salesperson, and drives home 4 hours later in a 2025 RAV4. $38,500, 5-year loan at 6.9%, monthly payment $760. She feels good. New car smell, full warranty, latest safety features. The salesperson told her the payment fit comfortably within the standard affordability guideline, and she believed him because the payment did fit, on paper, in isolation, without the full picture of what that decision costs across 60 months. Person 2 drives 30 minutes to a private seller he found on Car Gurus. He buys a 2022 RAV4, same trim level, 31,000 miles, full service history for $26,500. He puts $3,000 down, finances $23,500 on a 3-year loan at 7.5%. Monthly payment $730, slightly lower than person 1. Same car, 3 years old, and a financial outcome over the next 5 years that is not slightly better, it is dramatically better, in a way that most people never calculate because the comparison almost never gets made with the full numbers visible. Today, we're making it with the full numbers visible. My name is William, and by the end of this video, the new car purchase is going to look like a significantly different decision than it did when you walked in this morning. First, what you're actually paying for when you buy new. The new vehicle has one cost that is unique to it and that no amount of warranty coverage, new car smell, or peace of mind fully compensates for: depreciation. A new vehicle loses approximately 15 to 25% of its value in the first year of ownership. Not through damage, not through neglect, simply by being driven off the lot and registered to an owner. The 2025 RAV4 purchased for $38,500 is worth approximately $29,000 to $32,000 12 months later, a loss of $6,500 to $9,500 on a vehicle that hasn't been in an accident, hasn't been poorly maintained, and hasn't done anything wrong except exist for 12 months in a market that prices newness as a premium that evaporates immediately. By year 3, total depreciation on a $38,500 vehicle averages approximately 40%. The RAV4 that cost $38,500 is worth approximately $23,000 at the 3-year mark. The original owner absorbed $15,500 in value loss, more than a third of the purchase price, in 36 months of normal driving. This is not a complaint about buying new. Some people have specific reasons that justify the new car premium: warranty coverage on a vehicle they plan to keep for 10 years, specific configuration unavailability in the used market, fleet discount programs that materially change the purchase price. But the depreciation cost is real, and it needs to be in the calculation before the decision is made, not discovered afterward when the trade-in offer arrives and the number is significantly lower than expected. The full 5-year cost comparison: new versus used. Let me run both scenarios completely so the comparison is exact rather than directional. New 2025 RAV4, $38,500. Down payment, $3,000. Loan amount, $35,500. Rate, 6.9%. Term, 60 months. Monthly payment, $700. Total loan payments, $42,000. Interest paid, $6,500. Insurance on a new vehicle in a mid-range market, approximately $200 per month, $12,000 over 5 years. Maintenance under warranty years 1 through 3 is minimal, approximately $1,500 for tires and routine service. Years 4 and 5 out of warranty, approximately $2,500. Total 5-year cost of ownership: $42,000 loan payments, plus $12,000 insurance, plus $4,000 maintenance, minus $3,000 down payment already counted, equals approximately $55,000. Residual value at year 5, approximately $20,000. Net cost after residual, approximately $35,000.
Used 2022 RAV4, $26,500, 31,000 miles. Down payment, $3,000. Loan amount, $23,500. Rate, 7.5%. Term, 36 months. Monthly payment, $730. Total loan payments, $26,280. Interest paid, $2,780. Insurance on a 3-year-old mid-range SUV, approximately $140 per month, $8,400 over 5 years. Maintenance across 5 years of ownership, the vehicle reaches roughly 100,000 miles by year 5, approximately $5,500, including tires, brakes, and standard service intervals. Total 5-year cost, $26,280 loan payments, plus $8,400 insurance, plus $5,500 maintenance, minus $3,000 down payment equals approximately $37,180. Residual value at year 5, the vehicle is now 8 years old with approximately 100,000 miles, approximately $10,000. Net cost after residual, approximately $27,000. That is the direct cost gap before opportunity cost. After month 36, Person 2's loan is paid off. Person 1 still has 24 months of $700 payments remaining. For those 24 months, Person 2 has $700 per month of cash flow that Person 1 is sending to a lender. $700 per month for 24 months invested at 7% annual returns, approximately $18,200. Total financial differential between the two decisions across 5 years, $8,000 in direct cost savings plus $18,200 in investment opportunity, $26,200. The interest rate reality. Why used car loans cost more and why it doesn't matter. The most common objection to the used car math is the interest rate. New car loans carry lower rates, often 0.9% to 3.9% for qualified buyers through manufacturer financing. Used car loans run higher, 6% to 8% for strong credit, higher for weaker profiles. This is real. The interest rate differential is real, and it is not large enough to change the conclusion when the full picture is calculated. Here's why. The interest rate applies to the loan amount. A lower rate on a larger loan frequently produces more total interest than a higher rate on a smaller loan. The 6.9% rate on a $35,500 new car loan generates $6,500 in interest across 60 months. The 7.5% rate on a $23,500 used car loan generates $2,780 across 36 months. The used car buyer pays $3,720 less in interest, despite borrowing at a higher rate, because the loan amount is smaller and the term is shorter. The manufacturer financing offer of 0.9% changes this math. If you can genuinely access 0.9% financing on a new vehicle and the rebate alternative to the low rate isn't worth more, the interest cost differential narrows considerably. Run that specific calculation before declining manufacturer financing. In some scenarios, particularly for buyers planning to hold the vehicle long-term, the 0.9% new car loan does compete more favorably with the used alternative than the standard rate comparison suggests. But 0.9% financing is available to a specific credit profile on a specific vehicle at a specific time from a manufacturer with a specific incentive to move inventory. It is not the rate most buyers receive. The average new car loan rate in 2026 is 6.37%. At that rate, the used car math wins clearly. The hidden cost nobody includes: insurance across the ownership period. The insurance differential between new and used vehicles is the cost most comparison articles omit because it's variable and harder to calculate than the loan payment. New vehicles require comprehensive and collision coverage for the life of the loan. The lender mandates it. On a $38,500 SUV, comprehensive and collision in a mid-size American market runs for $150 to $250 per month depending on your profile, zip code, and driving history. Call it $200. A 3-year-old equivalent vehicle with a loan balance well below its market value carries the same lender-mandated coverage requirement, but the premium is lower because the insured value is lower. Call it $140. The $60 monthly difference is $720 annually. Over 5 years, $3,600. This is real money that appears nowhere in the monthly payment comparison the dealership presents, and nowhere in the loan approval letter the bank sends. The total cost of vehicle ownership is the loan payment plus interest plus insurance plus maintenance minus residual value. Every number in that equation needs to be calculated before the decision is made. The dealership calculates one of them, the monthly payment, and presents it as the relevant figure. It isn't.
When new actually makes sense, the honest version. Buying new is not always wrong. There are specific circumstances where the premium is justified and the math supports it. If you plan to keep the vehicle for 10 years or more, the depreciation curve works in your favor over a long enough horizon. You absorb the worst of it in years 1 through 3 and then hold the vehicle through the period where annual depreciation is minimal. The total depreciation cost per year of ownership decreases the longer you hold. If the specific configuration you need, trim level, powertrain option, color combination, is unavailable in the used market at a price that closes the gap with new, the premium for getting exactly what you want from new inventory may be worth it. If manufacturer financing at a genuinely low rate is available and the cash rebate alternative is less valuable than the rate savings across the loan term, calculate both and take the better one. And if you're buying a vehicle type with historically strong residual values, certain Toyota and Honda models hold value well enough that the depreciation cost is lower than the average market comparison, the new car math improves relative to the broader market comparison. Outside these specific circumstances, the used vehicle, 2 to 4 years old, 1 previous owner, full service history, certified pre-owned if available, delivers a materially better financial outcome across any 5-year ownership period than the equivalent new vehicle at current market prices and current interest rates. Person 1 is making $700 payments for 5 years on a vehicle worth $20,000 at the end of them. Person 2 finished paying in month 36, invested the freed cash flow, and arrives at month 60 with a paid-off vehicle and approximately $18,000 in an investment account that didn't exist when she drove off the used car lot. Same Saturday morning, same vehicle, same monthly payment within $30, completely different 5-year financial outcome. The full math was available to both of them before they signed anything. One of them ran it. The new car smell costs more than most people calculate. The used car that replaced it costs less than most people expect. Subscribe for a new video every week and drop in the comments, new or used, and what made the difference in your decision.